In this lecture, we are going to explore the main differences between the standard technical analysis that most traders use in the market, and the high-quality technical analysis that you are going to learn in this course. There are important differences between the two. First, we should clarify that technical analysis is the trader's only weapon to access what's going on in the market using price charts. Technical analysis can usually be divided in two main categories. The first is the raw price action analysis. The second is the use of technical indicators to process the raw price data in the attempt to extract useful information out of price. The price action analysis itself can be divided in two subcategories, which are the price nuance reading and the various types of lines that a trader can draw on a chart like Fibonacci levels, pitchforks, channels, support resistance lines and so on. Here is where the problem of standard technical analysis begins. The initial impulse of new traders is to cluster their screens with many different technical indicators. That's usually done by naively assuming that each technical indicator provides a qualitative value that other technical indicators don't. That's false. Most technical indicators are basically smoothing algorithms. In other words, most technical indicators attempt to smooth out the noisy and raw price action. The need to smooth out price data comes from the confusion a trader feels when he stares at an apparently chaotic price chart, which is normal when the trader is not used to deep price analysis. However, this impulse goes precisely in the opposite direction of what the trader should be aiming for. A price chart is already a limited source of information. By smoothing out price, the trader is losing even more information. One can argue that it is useful to observe the relationship between raw price and a smooth line on a chart, which can certainly be the case sometimes. However, the trader needs to be careful about how much he is going to rely on smoothed price data. I am calling your attention to smoothed price streams like in a moving average, for example, because of the Bonini's paradox we saw in earlier lectures. Once again, the Bonini's paradox states that any formula to describe a complex system like the markets becomes less understandable as it becomes more complete. That means that a reliable smoothing algorithm should be almost impossible to understand due to the complexity of the markets, especially its nonlinear nature. However, if we look at indicators' formulas, we will notice that they are incredibly simple. A simple moving average, for example, is just an average of the last x values of raw price. By the light of the Bonini's paradox, a simple algorithm like a moving average is useless to derive useful information out of the market. On the other hand, since the markets are complex, and many traders have learned to look at moving averages and respect their role in the markets, a trader sometimes can use these simple algorithms in very specific situations. The point I'm trying to make here is that from a theoretical point of view, trying to smooth raw price action is usually a bad idea because we tend to lose useful information in that way. A good example of that is grounding your trend bias in a moving average angle. Since moving averages are smoothing algorithms, they produce a considerable amount of lag. The immediate effect of using this as a method to determine the trend is that you are always going to be behind the market, not ahead of it, which is precisely the opposite of what you want. It's also important to point out the trade-off between lag and smoothness in technical indicators. If you want to increase the level of smoothness in data, you will always increase the amount of lag. Basically, the smoother you get, the more lag you generate. There is some debate about trying to increase smoothness at the same time lag is decreased, and that can be done to a certain degree, but not to the point where it becomes useful. Another problem with smoothing price action is that we need to choose an arbitrary period value to feed the smoothing algorithm formula. For example, we need to choose the period of a moving average. By doing that, we are assuming that this value is equally applicable to all market scenarios, and that is a serious mistake. That's the case because price action is nonlinear. In other words, it is impossible to box the market within a linear formula. That's why moving average crossovers work sometimes and fail others in an unpredictable way. Beyond that, price action has something called temporal unpredictability of nonlinear shifting. In simpler terms, if we were able to describe the market with a formula, this formula would change from time to time. Worse than that, the frequency in which this formula would change would be unpredictable as well. That's the starting point of the Bonini's paradox. As you can see, you must be careful if you want to apply formulas in price action. Another way of looking at the financial markets that is useful to really grasp its complexity is through the lens of chaos theory. The financial markets are a chaotic system of the second order, which means it's a system that responds to prediction. The fact that when somebody tries to predict the market they are contributing to make the system even more complex doesn't really help predicting it. Another example of chaotic system of second order is the political system. A good example of a chaotic system of the first order, which is where a prediction doesn't affect the system, is the weather. The problem is that the financial market functions by a pure system of supply and demand, and like most productive endeavors, it is bound to the Pareto principle. The Pareto principle states that a small minority of people will produce most of the outcome in any given system. For example, a small minority of soccer players score most of the goals. A small minority of artists produce most of the music that is heard on the radio. The financial market is no exception, so a small number of traders will make most of the money. The Pareto principle is the main driver behind inequality of outcomes. Some people might argue that this is an inherent flaw of the capitalist system and its supply and demand mechanism, but if we look at communist or socialist systems and their distribution of power, we will notice that the inequality of outcome is even greater in practice than in capitalist systems, which is exactly the opposite of what the theory that critiques capitalism states. The bottom line is that the Pareto principle seems to be a fundamental law that drives human endeavors. Another way to look at the Pareto principle within the context of the financial markets is that the traders who have more money tend to make even more, and the traders who have less money tend to make even less. The point I'm trying to reach here is that there are traders with an incredible amount of capital power, which is enough to tilt the markets at specific points. If you combine this idea with the fact that the financial markets are a chaotic system of second order where the predictions alter the system, you will arrive at a scary conclusion. The conclusion is that there are traders powerful enough to maneuver the vast majority of retail traders in the market through reverse psychology techniques. These techniques work within the context of the most well-known concepts of technical analysis and the most relevant cognitive biases of the human mind. However, there is a time and a place for that. In this lecture we are focusing more on the main differences between good and bad technical analysis. Let's create a comparison chart to observe these differences more clearly. The first difference is that good technical analysis doesn't rely on smoothed price streams too much. We are certainly not going to add 7 different technical indicators in our charts. The second difference is that good technical analysis usually takes fractal analysis into consideration. This idea is closely correlated with the use of the trading principles that we studied in previous lectures, which are completely ignored by the bad side of technical analysis. Good technical analysis worries about reaching the truth of the market through well-constructed contexts, while bad technical analysis has an overly optimistic and pragmatic preoccupation with setups and tricks to enter the market. Good technical analysis tries to go in the direction of price action noise with the intent to find its underlying order, while bad technical analysis tries to obfuscate price action noise in a naive attempt to turn a nonlinear dynamic into a linear dynamic through simple formulas. Good technical analysis respects the Bonini's paradox while bad technical analysis is completely alienated from it. High-quality technical analysis also takes into consideration the Pareto principle and the fact that markets are chaotic systems of second order. Bad technical analysis assumes the markets are a completely leveled playing field where all market players have equal power. Now we are ready to explore the specific techniques that are going to be used in this trading strategy.